Have you ever wondered what a private equity firm or similar investment firm looks at when they're actually valuing your company and the checklists and step-by-step frameworks that they actually use? I recently have been looking into quite a large deal that I've gone in with myself and my partner that we've actually been looking into for quite a large financial services acquisition. And today we're going to jump into the exact 6 stages that I looked at and the checklist I actually looked at for us actually valuing and seeing if this company was actually worth buying. So let's jump right in. The 6 value drivers. Okay, so driver number 1 is going to be your EBITDA margin quality. Now, I'm obviously referencing off the back of a previous video that I did last week, which was how to actually exit and at the different stages. Okay, so driver number 1 is going to be what percentage is your EBITDA margin as number 1, meaning if your EBITDA margin is at 10% with a company that does $2 million per year, that's going to be significantly worse than a company who is doing $2 million per year but is at 30%. So that's just one thing straight away. Don't focus on revenue, focus on profit, okay? Buyers literally pay premiums for businesses that have real cash flow and very strong margins because they also know that they might be able to buy this for an acquisition that will support their other company and they can literally dump in more resources to ramp up volume so that it feeds their other company and makes less money over here. I'll give you a direct example. This is something I've thought of for years, is you buy a brokerage, you put down, say, it doesn't really matter. Let's just say you buy a brokerage that does 5 million, an asset finance brokerage that does 5 million per month in actual NAF, like net amount finance. So you buy that and then you get a back-end financier to back you and they give you, say, the first 6 months worth of capital so you can do it. And let's say hypothetically there's only 20% of that 5 million, which is 1 million, that you actually are able to match with the finance product you've just gone and secured finance for. So you've now gone from making 3, 4, 5,000 a deal to making 50, 60, 70,000 per deal because you now own the back book on the back. Okay, so you acquire the front end and you look at the back end, and that's what acquirers are looking for. Okay, so basically how to improve it, you raise revenue per producer. So basically making sure everyone's hitting KPIs before you actually bring on new headcount. So say business finance, you want to hit 30, 40,000 a month. Mortgage finance, you want to hit just a bit below that, about 30, 35,000 per month. You need to cut underperforming staff and any low margin service lines, okay? Meaning if you're trying to refer deals out for insurance, cut that if it's not making profit, just move on. You obviously need to renegotiate vendor tech and carrier / lender split. So what that means is vendors. So let's say hypothetically, you actually do have an internal finance that you're making brokerage off as part of a group. Make sure you're getting better rates there. Tech, let's say you're paying for example, some kind of aggregator tech. You need to make sure that that's actually at the best rates possible. And then obviously lender splits, what you're getting paid from lenders. Make sure you have agreements in place that are going to be doing the best, whether that's through your aggregator or through direct to the lender. And then push price on your top 20% of clients. So what this means, it doesn't mean push price. It just means your top 20% of clients want more service from you, and they probably want bigger loan amounts and bigger amounts from you, okay? They want your help more. So make sure that you're actually doing that, okay? Because every deal you get off an existing client exponentially drops to bottom line, meaning profit, okay? Number 2, revenue composition, okay? So recurring revenue, repeat revenue, referral revenue is worth way more than, say, paid ads, for example. Paid ads is unbelievably good at the start and while you're diversifying channels. But if I could choose between paid ads and a referral source, I'm choosing referral source as you would all day long. So basically you need to make sure you have a formal retention and reactivation system. So let's say you're a mortgage company. You need to make sure that in 6 months you check in to see if they want to buy an investment property, or you check in 1 year to see, I wouldn't say refinance because that might cut your book off if you got a 2-year clawback, but hypothetically you don't have a 2-year clawback and you check in at year 2. You check in then. Also tracking recurring versus transactional revenue as a KPI, meaning how many of your clients are coming in as a second purchase, meaning recurring, and how many aren't. And then making sure that that number of how many that are actually recurring is directly related to the formal retention and reactivation systems, okay? Number 3 is going to be client revenue concentration. So what this actually means is, for example, we'll give 2 massively different ends of the stick. Imagine you are a mortgage brokerage and you have one client who refers all of their deals to you. Let's say you're a mortgage company, you've got a massive business finance company that feeds you mortgage leads. That is not good and is never going to be valuable. Okay, so that's a huge thing here. And to give you an example of this previous company that well, not previous, like currently looking at for the deal, it has one source of leads and it was an internal company owned by the actual founder. So imagine this, you got to buy a company, there's one source of leads that funds 95% of all the deals. And the source of the leads is a company that he doesn't want to include in the sale and wants to keep separate. So that is a very big no-no in terms of actually a scalable company, because now it has no lead source, it has no actual control of the lead source. You can't ramp it up, can't ramp it down. There's nothing like that, okay? So you need to make sure that if you have one big client that's your referrer, you get multiple referrers. And let's say, for example, you buy leads on a pay-per-lead basis and you have one lead partner. You need to make sure you now have 2 or 3 lead partners, okay? You can never have one referral partner that has more than 50% control, okay? Lock in long-term agreements with your largest accounts on front end and back end, and make sure you also spread those relationships around multiple team members, not just the founder, okay? So that decisioning, ongoing operations isn't just put into one person's hands being the founder, okay? Number 4 is team independence. I would say this is probably the biggest one, and one of the ones in the recent look into this financial services company that they were unfortunately missing. Founder is the operator. Huge key man risk, which means very difficult to even look at that. And if you're wanting to go past, 5x multiples, you need the business to be able to run without you. Okay. So think right now, can your firm operate for 90 days if you went on holidays? And probably not. Like, for example, in all honesty, right now, biz leads can't run without me. And that's 100%. The only thing I'll say to that is I'm not trying to sell, but that's just meaning that it's not far enough ahead as I would want it to be. And there's not someone in here. But I have other companies that are completely running without me 100%. I just meet with them 1 hour per week. So that's fine. But make sure that is the thing that you're looking at. Now, do clients have relationships with other team members? Meaning, are they all with the founder? Do you have a COO who's running operations? COO just meaning general manager, someone who manages day-to-day operations. So if you have a head of sales or you have brokers, who do they actually report to? Who does weekly meetings? Who does the weekly one-on-ones? Who does the daily huddles? And then do producers actually bring in their own clients? Now, this is one that means more so around the relationships of how they're getting leads as well. So if you have the COO who's managing all the paid ads, who's managing all the referrers, for example, that's amazing. That means you're not having to do it. So they're able to bring in clients and ramp up and basically have control over the profit and loss of their division. Now, how do you prove? You hire straight away. If you're doing over 7 figures in EBITDA, over $80,000 per month, and you're the founder, okay, you need to hire a COO to basically be able to help down on the actual brokers that you have under you, okay? And then transition any founder-owned client relationships to now senior team members. So if that's previous referrers that you work with, you need to start having an actual system. So every time you have a next meeting, maybe you and the COO go on together, or you and the head broker go on together, and you start doing that. The number one thing I would say is documenting your sales and service and operations, which is just your SOPs. Okay, if you don't have SOPs, I'll tell you this is not a slight. Whoever sees this is not a slight towards someone. But the deal we were just working on said, "Oh, where's your SOPs?" And they're like, "Yeah, we've got them written down probably 5 years ago. But what we're actually going to do is, when you put in a formal offer, you're going to come down to us, and we're going to rewrite them." And that's just basically telling me that you don't have SOPs. That's all it meant, like from my eyes. So yeah. And now build a producer comp plan that rewards bringing in their own clients. So that is one that links to this one, which is basically if they can go out and find a new high quality lead source, do they get a $10,000 bonus, a $5,000 bonus? Do they actually get things for actually bringing in huge amounts of revenue for the company? And the answer should be yes. Number 5, growth and retention metrics. Okay. This is just about general growth. Okay. So this just means you want to be seeing over 20% year on year for multiple years. Okay, you need a year on year track record. That's the biggest thing, because they then know. Imagine you've got a COO, you've got someone running it, you've got 3 different lead sources, you've got a way that you can bring back 30% of all clients, and you've got a proof that you can grow every single year. They're going to be like, I will buy this business because I know that next year I'm going to get 120% of the current that I got. And then Watch the other videos on my channel to actually show how you jump the 20%. Don't like I won't cover how to keep growing 20% for here. But make sure you track organic growth, retention, and new clients monthly versus the older clients as well, meaning that you constantly are on, basically, you know what are recurring clients and you know what are new clients, that you actually have those growing in the same direction as well, not just one dropping off. And then obviously explicit growth and retention targets for every single team member across the team. Now, driver number 6 is a special mention, and it's not required, but it's how you get enormous multiples. Okay, this is how you truly become different in the market. So to be the market leader, let's say in deal sizes, you need a fewer amount of deals with the same revenue, so you have a lower service cost and more profit per transaction. So what does this actually mean? It means that you pick a niche where you can credibly be number one in bigger deals. Give you an exact example. I've got someone I know in the industry, and they do mainly self-employed mortgages, and they are very, very good at self-employed mortgages. They would be considered, I'm not going to say what their ranking is, but very, very high in the industry. And they're known for just being high net worth, self-employed mortgages. Their average deal size is it's way more than, let's say you do an average $500,000-$600,000 mortgage, you're getting about $3,000-$3,500. They are probably getting 3 times that because the average house value that they're dealing with is 3 or 4 times the average. So you need to pick a niche where you can credibly be number one so you can go for bigger deals. And then raising minimum deal accounts every 6 months, meaning if someone comes to you and they are going to be worth $500,000, but you know that you've got another deal over here that's worth $2.5 million, you need to pick the right deals and keep moving forward and let it be clear to everyone publicly known that you deal with this client. I know it seems good to take these people's money, not take their money, but like to help them out in finance. But you're here to make money and continue to grow your business, because if your business was 3 times the size today, you'd be able to help more people than if your business is the current size today. And then reposition your marketing around the largest wins, meaning that, again, you're super targeted and you're building your brand around that specific niche and being that leader in that market. Number 6, absolute huge driver. So just to recap, number 1, EBITDA. Need the highest percentage. Value profit over revenue. Revenue composition, making sure that you actually have recurring clients, not just clients that are new every single month. Making sure your lead, either the clients who refer you deals or the lead sources that you get your leads for, are from multiple different things with over 50, never with over 50% from any one channel. Team independence, making sure you have proper structure so you're not needed to run day-to-day operations. And that doesn't mean, by the way, that you are completely out of it. It just means that you're working on what grows the business. You're getting a bigger referral partner. You're getting a bigger lead gen. You're hiring in systems for bringing on better brokers. It's becoming better. You're going to aggregators to negotiate better deals. You're doing things that aren't day-to-day, worrying about KPIs. Driver number 5, growth and retention metrics, making sure that your retention metrics for clients as well as your growth metrics are continually going up at around 20-30% or more. And then, as I said, number 6, the bonus, trying to be a market leader in a specific niche. And specific niche doesn't just mean mortgages, it means mortgages for self-employed high net worths. It means an actual niche, because whether you're in America, Australia, United Kingdom, wherever you are, the market is big enough for this. I guarantee you there's 50 or 100 or more deals per month in nearly any given niche that is hyper specific, okay? And that's huge. I'm not sure how many of you are doing a 50 or 100 deals per month, but that's a very nice sized company if you're doing hyper specific 50 or 100 deals per month. So yeah, so those are the 6 biggest drivers. So I hope that made it super clear on the exact process that I actually went through very, very recently. And that's the exact 6 drivers. And number 1 being the bonus one, but the main 5 that I actually look at in order to value a company, to have the initial checklist of it even to be worth going for in the first place. Because then from there, you obviously need to verify that all those things are correct. But just at a glance, you need to make sure it has those 5 things, with 6 as a bonus. So hopefully that was good. Hopefully it made sense. Like, comment, subscribe, and I'll speak to you soon.